The United States Treasury Secretary went on national television and told you that China caused the silver crash. That is the official position of the United States government. 14 words on Fox News. Things have gotten a little unruly in China. And with those 14 words, Scott Bessent handed every financial outlet in America a ready-made explanation for one of the most violent precious metals crashes in modern history. Neat, clean, explainable. And when you put it against the data that was available before, during, and after the crash, it does not hold together, not even close. Let me show you exactly what the deflection looks like, why it was deployed, and what the data that nobody in mainstream media examined actually says. February 8th, 2026. Fox News Sunday Morning Futures. Bessent is asked about the record-breaking rally in precious metals that reversed violently the week before. Silver had peaked at $121.64 per ounce on January 29th. Gold had hit $5,594. Both had roughly doubled in 12 months, and then in the space of 48 hours, silver crashed 31.4% and gold shed 9% in its sharpest single-day drop in decades. The official explanation up to that point had been the Kevin Warsh nomination triggering a hawkish Fed repricing, but the Treasury Secretary had a different story. Things have gotten a little unruly in China, Bessent said. They are having to tighten margin requirements, so gold looks to me kind of like a classical speculative blow-off. That was his complete explanation. Chinese traders got too leveraged, Chinese regulators yanked the brakes, and the rally collapsed under its own speculative excess. Move along. Here's the first problem with that explanation. The CME, which is COMEX's parent exchange and the largest derivatives marketplace in the world, raised margin requirements on silver futures from 15% to 18% on February 2, 2026. Not China, the CME. Located in Chicago, Illinois. Regulated by the Commodity Futures Trading Commission, a United States government body, the CME raised the initial margin on COMEX 5,000 silver futures by 3 percentage points in a single move immediately following the crash. And they had already raised margins on the March 2026 silver futures contract to $25,000 from $20,000 in late December 2025, a move that had been documented and published through CME Advisory Notice 25393, two separate margin hike sequences, both on the American exchange, both affecting paper silver traded in New York, both deployed at moments when the silver price was under extreme pressure. When Bessent appeared on Fox News and pointed at China for tightening margin requirements, the most consequential margin hike in this entire episode had already been executed by the institution that sits at the center of American commodity trading. That is not a coincidence you can resolve by reading the headline carefully. That is a specific documented fact that the Treasury Secretary's framing directed your attention away from. Let me give you the historical context for why this specific tool matters so much. In 1980, the Hunt brothers had accumulated more than 200 million ounces of silver, using leverage through futures contracts to push price from $1.50 per ounce in 1973 to nearly $50 per ounce by January 1980. The CME's response was Silver Rule 7, a single rule change that imposed stringent restrictions on margin buying, effectively requiring traders to put up nearly 100% cash for positions instead of borrowing on margin. Leverage eliminated. The rally collapsed from $50 to $10 within 2 months. The Hunt brothers incurred over $1.1 billion in losses and eventually declared bankruptcy. In September 2011, silver had surged from $8.50 to $50 on zero interest rates and quantitative easing. The CME raised margin requirements 5 times in 9 days, from $9,000 per contract to $21,600. Forced liquidation sent silver crashing 30% within weeks and into a 9-year bear market. The CME has used this mechanism twice in modern history to break parabolic silver rallies at critical moments. In 2026, they did it again. Silver futures initial margin went from 15% to 18% on February 2nd, and the Treasury Secretary went on Fox News and pointed at Beijing. Now let me address what was actually happening in China, because the Chinese angle is not fabricated. It is real. But its role in the story is very different from the one Bessent described. The UBS SDIC Silver Futures Fund in China had been trading at a staggering 36% premium over its net asset value before emergency suspensions were enacted. Chinese authorities did tighten domestic margin requirements on their own exchanges. That is documented. The Chinese market was genuinely overheated. Retail speculation in Chinese silver ETFs and futures had reached levels that regulators considered unsustainable. All of that is accurate. But here's the critical distinction. The Chinese silver market is a separate market from the COMEX. Chinese domestic silver prices are set on the Shanghai Futures Exchange. COMEX silver prices are set in New York. They are connected through arbitrage, but they are not the same market. And a margin hike on the Shanghai Futures Exchange does not mechanically force liquidation of COMEX silver futures in New York. What does forced liquidation of COMEX silver futures is a margin hike on COMEX itself, which is what happened. On February 2nd, in Chicago, the CME raised initial margins on COMEX 5,000 silver futures from 15% to 18%. That increase applied to a market where speculative net longs in silver had reached near record highs according to CFTC commitment of traders data from late January, forced traders who had built positions using maximum permitted leverage to either post additional capital immediately or liquidate. Many liquidated. That liquidation created selling pressure. That selling pressure created more price declines. Those price declines triggered more margin calls. The cascade mechanism is identical to what happened in 1980 and 2011. The exchange tightened requirements. Leveraged longs were forced to sell. Price crashed. The Treasury Secretary appeared on television and described a version of events in which a foreign country's regulatory decisions were the primary cause. Let me examine the timing more carefully because the sequencing of these events is where the deflection becomes most visible. Silver peaked at 121.64 on January 29th. The Kevin Warsh nomination landed January 30th and triggered the initial algorithmic sell-off. Silver fell approximately 31.4% in futures on that day. On February 2nd, the CME raised margin requirements. Gold and silver fell further as the margin hike added to existing selling pressure. CNBC reported that gold and silver prices dropped as increased CME margin requirements added to the selling pressure following last week's sell-off. That is CNBC's own language. The margin hike adding to selling pressure, not causing it exclusively, adding to it. The cascade was already in motion from the Warsh nomination. The margin hike amplified and extended it. And on February 8th, the Treasury Secretary appeared on Fox News and said things have gotten a little unruly in China. Not a word about the CME margin hike. Not a word about COMEX. Not a word about the documented history of exchange margin requirements being used as a precise tool to break silver rallies. Just China. Unruly. Speculative blowoff. Classical. Here is what makes that framing significant beyond this specific episode. The Goldfix analyst who covered Bessent's Fox News appearance put it in plain terms. When Bessent says they are having to tighten margin requirements, it means he has asked COMEX to bring gold down, or at least slow it down, and they are obliging by raising margin. Either that, or he knows the CME has to do it anyway to protect treasuries, the dollar, the bullion banks' solvency, or all three. That is the interpretation from someone who reads CME performance notices daily as a professional requirement. The Treasury Secretary describing Chinese margin tightening immediately after COMEX margin tightening is either an extraordinary coincidence of timing or it is a communication designed to direct public attention toward Beijing and away from Chicago. Now let me put the structural argument together because this is where the Bessent deflection has its most damaging effect. If the silver crash was primarily a speculative blow-off driven by Chinese retail excess, then the correct conclusion is that the structural case for silver was overblown, the price went too far too fast, and the correction represents a return to fair value. That is exactly the conclusion the speculative blow-off framing is designed to produce. And it is wrong on every single structural measure that was true before the crash, during the crash, and remains true after the crash. The Silver Institute confirmed the 6th consecutive year of structural supply deficit for silver in 2025. 67 million ounces more demand than supply. That deficit does not disappear because leveraged Chinese ETF traders got margin called. India is projected to import approximately 220 million ounces of silver in 2026, roughly 25% of total global annual mine production from a single country. That demand does not evaporate because the Treasury Secretary called the rally a blow-off. COMEX registered silver inventories, the metal actually available and warranted for delivery against futures contracts, have fallen approximately 70% over 5 years according to multiple documented sources. The physical silver available to back paper claims has been declining steadily for half a decade. That drawdown did not reverse during the crash. It continued. China controls 60% to 70% of global refined silver production and is introducing a silver export licensing system starting January 1, 2026 that limits overseas sales to large state-certified producers. That supply constraint does not disappear because Chinese margin requirements were tightened. It intensifies. March 1st notice day sits 13 days from today. Open interest in March silver contracts represents hundreds of millions of ounces of paper claims against the 82 million ounces of registered physical silver currently in COMEX vaults. That ratio, that fundamental mismatch between paper claims and deliverable physical metal, was not created by Chinese speculation. It was built over years by the structural design of a fractional reserve paper market where paper silver can be created in theoretically unlimited quantities, while physical silver must be mined, refined, and stored at real cost. No amount of Chinese retail leverage caused that ratio, and no margin hike in Shanghai changes it. Here is the physical market data that the speculative blow-off narrative requires you to ignore. During and after the crash, physical silver dealers maintained premiums of 15% to 25% over spot price for silver eagles and maple leafs. If the crash represented a genuine fundamental repricing of silver's value, physical buyers should have stepped back, demand should have dropped, and premiums should have compressed as supply exceeded demand at the new lower price. That is not what happened. Physical buyers treated the lower spot price as an opportunity. Premiums held. The U.S. Mint sold 1.4 million silver eagles in January 2026, the highest January on record. The Royal Canadian Mint reported silver maple sales up 38% year over year. The Perth Mint has a 6-week backlog on orders. Golden State Mint, one of the largest private mints in America, temporarily suspended sales because they could not source silver at all. That is not the behavior of a market where a speculative excess has been corrected and price has returned to fair value. That is the behavior of a market where the paper price was pushed below the physical clearing price by mechanical forces, and physical buyers immediately recognized the gap and moved to close it. The speculative blow-off narrative requires you to believe that the paper price is the real price, that when COMEX silver fell 31.4%, that number reflected the true market value of physical silver. But when physical dealers were simultaneously charging 15% to 25% above that crashed spot price and still selling out of inventory, the paper price and the physical price had decoupled. One of them was reflecting real supply and demand for actual metal. The other was reflecting the positioning of leveraged futures traders being margin called in New York and Chicago. The Treasury Secretary's framing asks you to focus on the Chinese leveraged traders being margin called in Shanghai and ignore the American leveraged traders being margin called on COMEX. But the COMEX margin hike is documented. The CME performance notices are public records. The dates are there for anyone who wants to look them up. Let me address one more element of the Bessent framing that deserves direct examination. He described the silver and gold rally as a classical speculative blow-off. That is a technical term from market analysis that describes a final parabolic surge before a major top, characterized by extreme volume, retail FOMO, and leverage that is unsustainable. The classic blow-off top is followed by a prolonged bear market. That is the historical precedent the term invokes. But the classical blow-off top description requires that the fundamental case for the asset was weak or non-existent, and that the rally was driven entirely by speculative excess disconnected from underlying value. The fundamental case for silver going into the crash was the strongest in decades by every documented metric. Sixth consecutive structural deficit, record physical demand, COMEX inventory at a fraction of its peak, central bank gold buying accelerating globally. De-dollarization trends documented across 14 years of data, China implementing silver export licensing, industrial demand from solar and AI data center manufacturing growing faster than mine supply expansion. That is not the backdrop of a classical speculative blow-off. That is the backdrop of a market with genuine supply constraints and genuine demand growth that attracted speculative capital on top of a structural foundation. When speculative capital enters a market with genuine structural constraints, the leverage unwind creates a paper price crash. It does not create a physical price crash. The physical price did not crash. The premiums prove it. The sold-out dealers prove it. The backlog at Perth Mint proves it. The Treasury Secretary described a speculative blow-off. The physical market described something else entirely. Now let me be precise about what I am and am not arguing here. I am not arguing that Chinese speculation played no role in this episode. It clearly did. The UBS SDIC Silver Futures Fund trading at a 36% premium over net asset value is a real data point. Chinese retail leverage in silver ETFs reaching breaking point is documented. Chinese authorities tightening domestic margin requirements is real. All of that happened. What I am arguing is that the Treasury Secretary of the United States went on national television and presented one piece of a much more complicated story as if it were the entire story. He described Chinese margin tightening without mentioning American margin tightening. He described Chinese speculative excess without mentioning that COMEX open interest in silver had also reached near record speculative net long positions according to CFTC data. He described a speculative blow-off without mentioning that physical demand at the dealer level never validated the paper price crash. When the highest financial official of the most powerful government in the world gives you a partial explanation for a major market event, the professional obligation of anyone covering markets is to ask what the partial explanation leaves out. What it leaves out is that COMEX raised silver margins from 15% to 18% on February 2nd. What it leaves out is that this is the third time in modern history the exchange has used this specific mechanism to break a parabolic silver rally. What it leaves out is that physical premiums held through the entire crash and physical buyers treated lower spot prices as an opportunity rather than a confirmation of lower value. What it leaves out is that the structural supply deficit, the COMEX inventory drawdown, the physical demand records, and the de-dollarization trends that built this market over years are all still intact today, exactly as they were before the crash. The speculative blow-off framing, if accepted, tells you to move on. The structural data, if examined, tells you the fundamentals that built this market have not changed, and the gap between the paper price and the physical market's revealed preference is one of the most significant signals available. Bessent went on Fox News and said things have gotten a little unruly in China. He is not wrong that things got unruly in China. He is wrong that China is where you should be looking. The CME performance notices from February 2nd are public records. The COMEX registered silver inventory data updates daily. The Silver Institute's deficit reports are published and available. The physical dealer premiums are observable by anyone who calls a coin shop this week. Every piece of data that contradicts the speculative blow-off narrative is publicly verifiable by anyone willing to look. The question is whether you accept the 14-word explanation from a Fox News appearance or do the work of checking the documents that tell the rest of the story. The Treasury Secretary said China was unruly. The CME margin notice from February 2nd says something different. The physical dealer premiums say something different. The U.S. Mint sales records say something different. The COMEX inventory data says something different. The Silver Institute deficit report says something different. That is a lot of documented evidence pointing in a direction the official narrative did not point. The deflection was clean, simple, and nationally televised. The data is available, specific, and publicly archived. You have both. Decide which one tells you more about what actually happened.